Welcome back to another episode of Building Wealth with Real Estate. So last time we talked about your first investment property, your first property being purchased. I did a deep dive into a property at 362 Moore Avenue in Yuba City, how to buy it if you're going to occupy one side and rent out the other, what to do from there, or if you're a first-time investor looking for a big tax deduction, or just a first-time investor, what should you do? What should you aim for? So in this episode, we're going to dive into a property in Citrus Heights. Once again, my name is Cameron Ripley. I'm the broker owner of Vision Forward Realty and Purpose Home Loans. And so I like to really talk about a lot of investing in real estate in our greater Sacramento area, which you can take the concepts and take them anywhere in America, to be honest. But I like to dive into things as if it was me and looking at this stuff, because I just found whenever I listened to some other videos on investing in real estate, it was a lot of general ideas. Not to say there's anything bad with that, not knocking anyone else's podcasts. I did not feel like there were enough specifics given. And whenever I personally was looking at investing in real estate, I felt super lost. So this is a great opportunity for us to really dive in. This is not an offering on one of our investment funds in real estate. This is just looking at a couple on-market listings, how to scale up your portfolio. So if you didn't see the last episode, please go watch that, because it's a good starting point if you're a first-time investor or if you're a first-time home buyer, how to scale up the property, how to really build the equity to a point where you can put 20% down and buy your next investment property as an investor. So this property is listed at 7234 and 7236 Adobe Casa Ct in Citrus Heights. So it's listed at $580,000. It's listed by, and I keep trying to say the name, but I think it's Chaitanya or Catania Lay. It's not Katiana because it's not spelled that way. So sorry if I'm messing that up. I know I am. But with Empower Property Solutions is the broker. It's being sold at a 6.4% cap rate. So in most markets, that's good. Depending on where interest rates are at, it may not be the best. This is why I always have to dive down or sit down with people to kind of see, okay, how much are you looking to put down? Let's see how much really is the cap rate with the money you're going to spend out of pocket. What is the upside potential? I do think there's a lot of upside potential with this one. So this one, if you're buying it as an investor, so all sides are rented out, you can't just live in one side and do a traditional mortgage with 5% down or a VA loan. You're going to have to buy it as an investor, which, depending on where the market's at, there are some lenders every once in a while that will allow a 10% down, but most of the time they require 20% down or more, just depending on so many other factors, right? So let's just say 20% down. That's $116,000. With the property we talked about in our last episode in Yuba City, I definitely showed you ways and talked about how we buy that, build the equity, rent out all this, renovate all the sides, rent out all the sides, get a good tenant in place where you pre-screened them, pass it off to another investor and do a 1031 exchange. Very easy to get to that $116,000 equity by renting out all the sides, increasing the rent, because most people are then going to be able to use a DSCR loan, so a debt service coverage ratio, where they can qualify just off the income the property is producing. This property here in Citrus Heights, if it's being offered at a 6.4% cap rate, it probably means that if you're using a DSCR loan, you're going to have to find a lender that has a no ratio requirement. So basically, I can use a lot of the property's income to qualify. I'll still need to use a little bit of my own income to qualify, but that opens the door so much if I already own my own house and I have a big housing expense with that house. So, or we can negotiate the price down to where it makes sense for your loan. So there's so many ways with a lot of these properties. The way I like to look at it with any of my clients is, this is a business decision. There will be more opportunities. Let's submit our offer at this because that's what makes sense to you and your situation. If they say no, we move on to the next one because there will be another one. We don't do whatever it possibly takes to get this and put yourself in a terrible situation. So the game plan with this property, it needs some work, right? I think there's a lot of upside potential with it. It is a duplex. Both sides are being rented out. I think both sides are being rented out a little bit lower than market value. However, I'm not 100% sure on the condition of the property, so that might have also been a reason why the market rent looks a little bit lower. People are willing to spend a lot more than apartment complexes because there's less shared walls. With a duplex, there's less shared walls. I've got my own backyard, just a lot more freedom and flexibility. And so the rates should be a little bit higher. But what you can do as an investor, and my goal would be, okay, I want to build the equity and take advantage of not only appreciation, but me increasing the rents 3 to 4% every single year, what's ever on the market trend, and really adding value. Because my goal is to get the net operating income as high as I can, so that if I sold at that same cap rate that I purchased it at, I'm going to have so much more equity to be able to transfer to my next deal that has even more upside potential. And that's going to be our next episode, where we talk about another deal with even more upside potential. But for this one, what we really want to dive into is, hey, whenever I look at, okay, here's my 20% down, I still want to factor in, okay, what's going to be the cost to renovate the units? Obviously, there's tenants in each side, so I'm going to try to increase the rent, not just to get them out, but I want to be able to get in there and make improvements, and that way I can justify increasing the rent, right? I find a lot of people will just increase rents, but they're not making improvements. Then you start to get a tenant getting frustrated. They start treating your property like crap because you don't care about your property, so they don't care about the property. The more that you add value to the property, the easier it is for them to justify these increases in rent, right? If I've got, and this is why sometimes with some of our real estate funds, we've gone and we've said, okay, we renovate one side that's vacant. We tell the tenant on the other side it's not vacant, hey, we'd like to renovate this side. Would you like to live in this other side and move all your stuff whenever you want? But would you like to live in that side for the same amount that you're currently paying, but it's a renovated side? And just see what they say. And I have found a lot of times people say, yeah, no brainer. And so they move into that side. But once I start increasing the rent, it's easier for them to justify that increase in rent. And now I have both sides renovated. After a year or two, I'm able to sell it at so much more of increased value because I've increased the income, which when you're basing it off a cap rate, I have increased the value. The other thing I like to look at is this property might be listed at $580,000. And to a lot of people, that sounds like a lot of money. And they're thinking, for my first investment property, shouldn't I buy something cheap in middle of nowhere America, like $100,000? At the end of the day, here's what I'm going to say about that. Let's say values increase year over year over a 5-year period, but year over year, 6%. If I buy a property at $100,000 and it increases by 6%, that's not a big increase. If I buy a property at $580,000 and it increases by 6%, that is a much bigger increase because the starting point was so much higher. This is why people in our greater Sacramento area complain about people from the Bay Area coming in and paying cash. This is why people in other states complain about Californians coming in and paying cash. We all have increases in value. It's where does your property start at when it's increasing in value? Because we might complain about that, but someone did whatever it took to buy that property that started at $1 million. And when you had a 6% increase year over year and you stayed there for 3 to 5 years, you got the cash to buy whatever property in another state. So don't be afraid by the higher numbers. Look at what is the deal going to do? Is it paying for itself? There's so many other details that we really dive in so that it makes sense for you. And this is what we do when we put together funds, but this is what we do just for our clients as individuals. So I would get in there. I would increase the rents. I would increase the value by making improvements. And then I would do a 1031 exchange to my next property or find a way to hold on to both and do maybe a second mortgage to my next property. The next property has so much potential, and I think it's then going to propel us to one of the bigger projects, which is coming up in a couple episodes. So stay tuned. Thank you for listening again.